Welcome to Catalyst. I'm Madison Mills. 30 minutes into the U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, U.S. stocks pushing higher as investors take on risk heading into the weekend. We bring you full market coverage throughout the hour. We'll also break down the latest jobs report as it comes in hotter than expected, but could a slowdown be on the horizon? We'll discuss. And we'll also look at what might happen to Elon Musk's space businesses amid the ongoing feud between the SpaceX CEO and President Donald Trump. Half an hour into the start of U.S. trading, let's get you a check on the markets. Taking a look at the major averages, we've got huge gains to the upside. You've got your S&P 500 up over 1%, your tech-heavy NASDAQ up nearly 1.3%. And taking a look at the major averages in terms of the sector action, we've got infotech as the biggest gaining sector at the moment here. But let's flip the board over to the bond market, taking a look at yields continuing to move to the upside. You've got your 10-year up 8 basis points. Your 30-year yield is up about 6 basis points amid traders trimming their expectations for Fed rate cuts to come below 50 basis points for the course of this year. Bucking what we are hearing from President Trump this morning. President Trump is calling for Fed Chair Jay Powell to cut rates after the better than expected May jobs report, saying, quote, go for a full point. But while unemployment is holding steady, higher costs from tariffs are broadly expected to start appearing in the upcoming inflation data. So which data point is going to be the most important for the Fed's rate decision? Unemployment data or inflation data? For more on this, I want to bring in my guest host for the hour. We've got James Demmert. He's the Chief Investment Officer at Main Street Research. And we also have with us to discuss James Egelhof. He is BNP Paribas Chief US economist. Thank you both for being here this morning. Great to have you here for the hour. But James, I want to start with you in terms of the labor market data this morning, showing perhaps a slowing but not a slow labor market. How concerned are you then about the inflation picture going forward?
Well, first of all, thanks for having me here. The jobs data is telling you that this economy is prepared to take a licking and just keep on ticking. We think businesses have learned from past business cycles that if they let people go or they pull back on investment when the economy softens, that those people they're scattered to the winds, those investment opportunities are gone, and then when the economy recovers, it's really impossible to bring it all back. You've given up market share permanently to make this tactical choice. So businesses have been gritting their teeth through the tariff uncertainty and holding on to their people, which sets us up really well for the resolution of that uncertainty in the coming months and a continued economic expansion. This is one of the risks, the nonlinear risk the Fed had been worried about was a recession. The other risk the Fed had been worried about was the entrenchment of high inflation into the economy and making inflation persistent. And the jury's still out on that. We probably won't learn much about how much inflation we're going to get or how sticky it's going to be until the late summer, which is what the Fed has been telling us today through a Wall Street Journal, a sourced Wall Street Journal article suggesting that they're on hold potentially past the September meeting.
Yeah.
And that lines up with the idea that they're going to take their time, focus on which of these two risks is dominant, and then make the right choice from that.
And James, I also want to bring you into the conversation. How does that impact your framework for thinking about U.S. stocks over the course of the second half of this year if the Fed is going to hold for longer?
Thanks, Maddie. And James, I would agree with you. I think this thing is much more resilient than anyone thought. With all the headwinds of tariffs and less fiscal spending, we've got this really tight labor market. And we would suggest that the economy's got to decelerate at some point given these headwinds. And as a stock investor, well, make sure you're really sector selective. What kind of industries and sectors would do well, maybe in a little bit of a softer environment. I think the AI trade still works because that's a theme that sort of transcends any of this tariff or headwinds of fiscal lack of spending. But we think markets can churn higher, particularly you can see today. Good news is good news today, and markets are up.
Is there a second best when it comes to tech? Obviously, tech is the best and has continued to be the best for the past couple of decades here. But what sectors are you looking at that are maybe a little bit more defensive for folks who are worried about that risk?
Yeah, I think there's a lot of value in select healthcare companies like McKesson or Intuitive Surgical, the robotic device. I think consumer staples, Costco had fabulous numbers. Walmart had fabulous numbers. So sort of stay in those more defensive areas. I also think investors should look overseas where you have the opposite economics. There you have fiscal stimulus and easy money, monetary policy. And that's why those markets are up a lot more than they are in the US. So different economic climate there.
Yeah, but following on your exact point on how the fiscal policy and the monetary policy both play into the macro picture, I'm curious how you are thinking about the totality of policy coming in from the Trump administration. We obviously have tariff policy continuing to unfold, and then we have the potential upcoming tax bill getting through. How are you thinking about the macroeconomic impact of that legislation?
So we're expecting the tax bill to get through later in the summer, and we think that provides broad continuity to the economy. It's a continuation largely of current policy. It's a continuation of the current high level of the deficit. So from a macroeconomic perspective, it's sort of neutral news. Where I think some of the worries are among some investors is about the high level of the deficit and the lack of a long-term plan to resolve it. This, combined with a lot of the other policy uncertainty you noted, has made people a little bit worried about the long-term credibility of fiscal policy, of monetary policy in the U.S. more generally. Yeah. And that's why we've seen the dollar stay at a relatively weak level despite the recovery in risk assets, and why the 30-year Treasury yield has risen so much and why it remains high. Yeah. So I think we're seeing some emergent signs of worry about credibility over the long term. And that's one of the reasons why we think the Fed stays on hold, is the Fed is one of the anchors that maintains credibility in the U.S., and we think they're going to guard that credibility very carefully.
Are we at a point then where the deficit is driving the tape more than tariff policy at the moment, in your view?
We think tariff policy matters more, and we think that the resolution of that uncertainty, as the administration has backed down a bit from brinksmanship and has shown more interest in making deals, that has been very supportive of risk markets in general.
And James, how are you thinking about the policy coming from Washington and the impact it could have on your investment theses?
I think what I've learned in the last couple of quarters, and maybe over the last 40 years, is that sometimes these policies, they come and go, and obviously this administration changing them on a dime. And go back to earnings, because our job is looking at equities all over the world and look for companies that can somehow plow through this uncertain environment, keep their profit margins higher or normal, and be successful. And I think if you look at it that way, we had this tremendous downside, 20% back up. The only thing that really remained the same is companies had better earnings than people expected, particularly in certain sectors. So I try to tell my team, let's turn the noise down about the tariffs. Let's focus on potential earnings. The economy, like James is saying, does have a lot to do with it. I would agree with James. I think the big risk for equities is a credit default or credit downgrade. In the U.S., we are concerned about that.
How worried are you about earnings growth in the second half of the year?
I'm always worried. My colleagues will tell you I spend half my time being worried and the other half being an optimist. We think earnings can continue to go higher. A lot of companies, particularly if you look at the semiconductor industry, they've not done anything for 6 months other than go down and come back up. So you've got a period where prices have been relatively stable, not going anywhere, but the earnings have gone up. And we think that relates to the second half, back half. You get an increase in equities, less volatility than we saw, obviously, in April. But we churn higher based on better earnings.
Really great overview. Thank you. And thank you to our James panel this morning. James, thank you so much for being here. And thank you, James. You're going to stick with us for the rest of the hour. Appreciate you both. We're going to have all your markets action ahead here at Yahoo Finance. So stick around. You're watching Catalysts.
The NASDAQ is up an eye-watering 26% from the April 8th market bottom, with large cap tech gaining over 30%. Chips and AI plays dominate the winners, but guess what? There are some surprises in the mix. I'm Jared Blickery, host of Stocks in Translation. First, a quick setup on these charts. We're showing 3 time periods all related to Trump and the markets. White bars at the left show the election to inauguration period. Green bars track from inauguration to April 8th. That was the market low. And then the blue bars, they tell the story from that April 8th low through right now. And that's where we're focused. So behind me are the biggest market cap gainers, led by NVIDIA's blue bar run of over $1 trillion. This week it reclaimed the title of world's most valuable company thanks to the unrelenting AI boom. By the way, it just lost that title to Microsoft again. The winners are the usual mega cap suspects, but don't miss out on Oracle and Netflix at the far right, both quietly adding over $100 billion each. Oracle is cashing in as the AI landlord, while Netflix, the stealth FANG member, remember them, it just hit a record high this week on analyst upgrades. And let's also pause for Tesla, the ultimate story arc here. A huge run-up post-election, a devastating collapse into the April 8th low, and just this week, a one-day $150 billion plunge courtesy of that Musk-Trump dust-up. Now let's talk about the best stock returns since April 8th, so returns instead of market cap. And at the far right on the top, it is storage chip giant Seagate. It is up an impressive 92% thanks to its signature drives feeding the data-hungry AI servers. But this isn't just a tech story. Look at the industrial and power trio here. GE Vernova, Energy, and Vistra, all up over 65%. Data centers need power, and these utilities are supplying the megawatts. Also, the industrial sector, by the way, just hit a record high this week, showing that the rally is broadening out just beyond the chip stocks. Now let's take a look at the flip side and see who's getting crushed since that April 8th bottom. Healthcare is definitely in the doghouse, led by United Health. A Medicare fraud probe and CEO exit erased nearly half of its value, $238 billion in market cap gone recently. And then you have Fastenal, a surprise 95% winner post-election, has given back over 40% of those gains with industrial demand weakening. And then there's Enphase, the residential solar darling, now down 36% on weak sales. Also note Brown-Forman. Yes, that's Jack Daniel's whiskey. It is down 22% on dismal earnings. And then there's Regeneron slipping 18% on drug pipeline worries. So here's the bottom line. Since April 8th, AI and chip stocks definitely leading the way. No surprise there. But don't miss the new kids on the block. We got the power producers supplying the AI energy boom. And meanwhile, the market's old guard, that would be healthcare, solar, industrial suppliers, it is stuck in the mud. New economy versus old, and right now the new economy is winning. But how long can that last? Stay tuned. And stay tuned to Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Jared, thank you so much. It's now time for some of today's trending tickers. This morning we are watching Tesla, Rubrik, and Samsara. First up, Tesla continuing to make up ground after that social media feud between CEO Elon Musk and President Trump. Shares moving higher after the stock lost $153 billion in market cap during Thursday's trade, the biggest ever one-day drop on record for the firm. According to the Wall Street Journal, President Trump even considering getting rid of the Tesla he had purchased earlier this year in a sign of support for the company at that time. I still have James in studio with me to provide context. James, how are you thinking about Tesla these days?
Yeah, Maddie, it's been, the volatility around the soap opera, I think is creating, a lot of investors makes them nervous, and I think it should. But I think what we have to do, as always, when there's volatility, look deeper in. Is this a company whose earnings and sales and revenue can turn around now that he's back in the seat? And I think that's, for us as investors, we felt we really can't be an investor in Tesla until he comes back and focuses on the job at hand. We do think the future is bright for Tesla. So my view here is use this crazy volatility, particularly the downside. If you don't own it, maybe pick up some shares to begin to build a position.
And not concerned too much about any executive risk more broadly for the stock. You think the earnings growth can outpace any Musk-related challenges?
Well, I think we always, at Main Street, we're always thinking about management, how good. Now that he's back, that's kind of our positive spin on that. But I would suggest if he ends up going back to the White House or somewhere else, I'm not sure I'd want to own the stock. So it's going to be very important that he stays, he's consistent, and he starts to really draw out that future, what the future looks like.
Great overview, James. We also want to talk to you about shares of Rubrik. They're giving back gains after beating Wall Street's expectations on the top and bottom lines. Shares rising in after-hours trading on stronger than expected revenue for the cloud services provider. KeyBank analysts raising their price target for Rubrik and maintaining their overweight rating after the report, citing its annual recurring revenue. We're seeing a slew of price target raises here from the likes of Wedbush, Cantor, Truist, and Piper Sandler. But the stock moving to the downside just a bit. James, how are you thinking about Rubrik?
We love the space, and I think the numbers speak for themselves. They beat on the top and the bottom. We've got some firms upgrading. Cloud storage, to us, the economy may slow in the United States with the lack of fiscal spending and tariffs, but AI, which is related to cloud infrastructure, we think is a growth story, and Rubrik is a great way to play that. The numbers were fantastic, and we'd be a buyer, and if I owned it, I would hold it. That's the space you want to be in.
A bullish signal for Rubrik. You heard it here first. All right, let's talk about shares of Samsara sliding after its sales growth guidance disappointed investors. While the software provider does expect revenue to grow in the second quarter to $373 million, that represents a slowing growth rate going forward. So again, that guidance disappointment really being key. We're seeing this throughout the earnings cycle, and those shares down over 7% as a result.
Yeah, in the miss, can't be taken lightly, and the guidance can't be taken lightly. This is a market, you probably have noticed this, it's very selective. There's some really great companies like Adobe that missed and guided down. And that stock's been in the trash bag for a while. Yeah. I think this one goes with it. I would stay away from any company that hasn't been able to prove great growth here in this environment, and particularly if they're not giving good guidance. There's so many alternatives in the software space related to AI that are doing the opposite with good guidance and better earnings. So I think as investors, let's stay away from that stuff that just isn't showing up well.
Is guidance a more important metric for you now than it has been previously because of the environment?
Yeah, it sure is.
Yeah.
And I think that Jensen Huang at NVIDIA, that's a good example, right? Really letting investors know this is where we think this goes with tariff headwinds, with a slowing economy. And I think that's the only thing we really can hang on to. If it's really tight management, really good management, we want to think about that guidance. We want to really follow that guidance.
Great overview, James. Thank you so much. Appreciate it. Let's talk about Elon Musk walking back threats to decommission SpaceX's Dragon spacecraft amid his public feud with President Trump. The Tesla CEO initially threatening to wind down the program after President Trump floated canceling government contracts with Musk's business, including SpaceX. Joining us now on this, Andrew Shannon. He is co-founder and CEO of Procure AM, an exchange-traded product issuer that launched the world's first pure play space ETF. I always love chatting with you, Andrew, especially when we've got news like this. Talk to me about how important government contracts are to SpaceX's future and how concerned you would be if those government contracts were to dry up off the back of this feud.
Well, certainly government contracts for many space companies, aerospace defense companies, for some are a lifeblood for that company's success. That said, we're in a pretty interesting scenario where SpaceX is, pretty much the biggest pure play space company that's out there. And they've achieved so many incredible milestones that it's tough to say who's more reliant on whom here. Is just SpaceX more important to NASA and the government, or the other way around? And so SpaceX has been able to see successes in government, defense, commercial, and even direct to customer with Starlink and its communication capabilities, that it may not be as reliant on government spending as maybe some other space companies are. But how reliant is the government on SpaceX? And I think that's going to be something that we'll see play out here. But at the same time, being that SpaceX is so important to the US space economy, the global space economy, it's certainly something that we wouldn't want to see slow down their progress, as so many things that they've created, like dramatically reducing the cost of launch and accessing space via reusable rockets. We want to see these incredible marvels continue to make it out into the marketplace.
And as I mentioned in the intro, you are known as the father of the world's first space ETF. Curious how this news impacts your ETF.
Yeah, so it's interesting to say, you have a lot of companies that are competing for various contracts, have existing contracts. To the extent that the government is not as willing to work with SpaceX, those could become, awards and contracts that are open to other companies. And some of those, we would certainly hope may end up being in our fund. But there's also all the consortium bids and whatnot. So Golden Dome is a huge, huge project. And SpaceX is potentially going to work with Anduril and Palantir and others for their consortium. It's tough to say how the government will view relationships with SpaceX, but certainly as an American citizen, I'd love to see the best companies, the best capabilities, and those most aligned with U.S. interest continue to win these various contracts. And so, for us, even though SpaceX isn't a holding in the fund, a lot of what they've done with reducing cost of launch and things like that, in many cases have helped out many companies, either space companies or companies that want to access space. And reducing that cost provides a lot of new opportunities for those companies. So It's certainly not happening in a vacuum. And SpaceX's wins, and many times our broader space industry wins. Yeah. But this could open up other opportunities for companies to compete that maybe weren't looked at as gold standard as SpaceX has been in the past.
And Andrew, how does the feud impact space investors more broadly at the moment?
It's going to be something that will play out over time. A lot of contracts are things that have long lead times. So if you need to launch things into space, saying, okay, we're actually going to pull away might not necessarily be a viable solution. And so companies like we've seen with Amazon and their Project Kuiper, they've relied on having multiple launch partners for getting their satellites into space. We may see more diversification in service providers. That said, companies that look to partner with SpaceX may be able to curry some more favor with them, showing support now in what is clearly volatile times.
And my guest host, James, has a question for you, Andrew.
Hey, Andrew, love the ETF and that you're the dad of it. What would your message be to investors? This kind of volatility, there's a lot of uncertainty, but given the longer term outlook, if there's a decline in the ETF shares, what's your view on what investors should do? Should they be a buyer on this kind of downside and this uncertainty?
So I'm not allowed to make recommendations, but I think one of the interesting features about UFO is that it is a global space ETF. So there are companies in the fund that aren't based in the US. And so like we've seen with Europe looking more towards European countries for defense capabilities, we've also seen that focus on space too. And so to the extent that foreign companies don't want to work with US companies as much, or foreign governments don't want to spend, and vice versa, something like having a global perspective and global diversification is something that I think was really important to us when we developed this fund. And so, space is extremely important. Historically, it's been very collaborative, but just because we may have some of the best space companies here in the US doesn't mean that they're not doing incredible things abroad. And certainly we're seeing some great innovation and updates out of China, out of Japan, across Europe and beyond, as many countries look to become leaders in the next space race 2.0.
Yeah, I imagine that your investors are thrilled that SpaceX is not included in the ETF today. Having said that, I am curious about the pipeline going forward for SpaceX and a potential IPO. How does this news and this feud potentially delay that, and what does that mean for SpaceX investors?
So interestingly, SpaceX has been kind of in this rarefied air for private companies. It's one of the most highest valued private companies in the marketplace. It's extremely critical to various industries, obviously space, but now with communications, both for governments, defense, and others. SpaceX is doing incredible things that we rely on. And so I think people may see this as an opportunity for some companies. People may see this as a headwind for SpaceX. But SpaceX has many missions that aren't reliant on government spending either. I don't think that people should necessarily be scared of space, but I think diversification is a tool that many people may use to navigate various headwinds and opportunities. We've seen companies large and small come into the fund as well as leave the fund, and so nothing is constant. But space is something that has become more intertwined with all different industries, certainly with the expansion of AI, big data, cloud computing, things where data moves from point A to point B. In many cases, it's reliant upon space, just like this interview wouldn't be happening without space. So I think people will continue to look at space and they'll find various ways of playing it. As far as IPOs, he's been able to see oversubscribed interest at many of these offerings. Being a private company, they have a lot of flexibility for how they raise capital. An IPO hasn't seemed like something that's been a high priority for Elon Musk here, and we've seen him have some great successes on both the public and the private side. Yeah. So it's going to be something where if they need the money, we'll see what happens. But so far, using private markets, they've been pretty good at getting that capital.
Yeah, it's a great overview, but we've got just about a minute left, and I want to get your take on kind of how Musk could potentially hurt the government. Looking at this from the other side of things, what do you think the likelihood is and the impact of Musk potentially following through on decommissioning the Dragon spacecraft, or even potentially cutting off the government's access to something like Starlink off the back of this feud?
So the irony with Dragon is that if he pulls out, Russia is pretty much one of the only other players that can help us access the International Space Station. We've seen hiccups with Boeing and Starliner, and those are things that you can't really afford to have when human life is at risk. And so Elon Musk pulling away might push us closer to potential adversaries, which is very interesting given the current geopolitical system. And so, this is going to be something that pulls out. I really hope that SpaceX doesn't pull away from working with our government and the companies here as well as abroad. But we see that the ISS is reliant pretty much on SpaceX and Russian Soyuz craft. China already has their own space station. Is this going to speed up the need for US and US companies to develop their own space stations, which could create additional opportunities? So I don't think anything is 100% negative or 100% positive, and we'll see as the storms clear.
Really appreciate your time this morning, Andrew. Thanks so much for breaking down the story for us. Appreciate it.
Thank you.
We got all your markets action ahead. Stick around. You're watching Catalysts. President Trump and China's Xi Jinping have agreed on an in-person meeting during a call this week. But while talks are a welcome sign for relations between the two nations, China's ongoing restrictions on rare earth minerals have already begun to impact industries reliant on the key materials. Joining us now with more, we've got Gracelyn Bhaskaran, Director of the Critical Minerals Security Program at the Center for Strategic and International Studies. Gracelyn, really excited to get some clarity with you because there's been a lot of back and forth about where these negotiations stand with regards to rare earth minerals. We know that China is allowing more limited exports of rare earths as part of these negotiations. Just talk me through where things stand with regard to those exports today.
So what happened in April was that China imposed export restrictions, which means that you now had to apply to get a license to be able to export these rare earths. What happened at the same time was China put 16 American companies, 15 of which were in aerospace and defense, on a list that they could not access these materials. After the negotiations in Switzerland, China did not agree to get rid of their export control framework, but they did agree to remove American firms off of the list, which means that they could now apply to get the permit to be able to get these materials. What we've seen, however, is that we had a very short supply of these materials here in the United States. And so we've seen that certain auto companies have already run out. We saw Ford actually to stop production of the Ford Explorer in Chicago because it hasn't been able to access these materials. There's a frustration right now that China is not issuing out all of the permits fast enough, creating these supply chain disruptions. Our understanding is that about 25% of permits have been approved. And given we are coming from a system where there was no permitting, you put in the order and you got the rare earths, this has been a shock to our industry here.
Yeah, talk to me a little bit more about the macro and market impact of that slow walking of these exports from Beijing as you just laid out.
So these rare earths are absolutely imperative for almost every industry. We use them in everything from our defense technologies, like our warships, fighter jets, missiles, lasers, tanks. They're in automotives, and I'm not talking just about electric vehicles, right? They're in your seatbelts, they're in the stereos of your car, they're in your steering wheel, they are in everything. They are in MRI scanners, cancer treatment. So the disruptions are being felt very quickly. Oftentimes when you have export restrictions, you may not feel them for 6 months to a year, which allows you the opportunity to create alternate supply. That's not the case here. We knew that when the restrictions came out, we probably had 60, maybe 90 days that we could last before we clean ran out. Even though we mine those heavy rare earths here in the United States, we have zero capability online right now to separate them here. So until early this year, even the heavy rare earths that we mined here, we sent to China for separation. We now hold those and are building our capabilities here.
Yeah, Gracelyn, great overview. I do want to turn to my contributor for a question. James, as Gracelyn was just sort of laying out the widespread impact of any slowdown in rare earth minerals being exported to the United States, does this stand out to you as sort of a really important red line in the tariff negotiations, given that impact?
It does, and I think Gracelyn made some good points. I mean, 95% of the rare earth minerals come from China. We need to make an agreement, and I was interested. 8 of those rare earth minerals you need to make an iPhone. So this tells us, we didn't see it in the first quarter earnings because that's the past. I'm concerned as we get into the next few quarters that companies start saying, seeing what Graceland is talking about, which they cannot get elements to create production, that really creates a real problem for earnings. So this is something we're looking at very closely.
Yeah, perhaps we'll see, as we've already seen tariff mentions skyrocketing on earnings calls, you might hear rare earths coming up a little bit more frequently in the future as well. Graceland, I want to bring you back into the conversation here. Who has the leverage in these discussions? Because as James just mentioned, the U.S. really requires China for these rare earths. So who has the kind of power play here?
China has the power play because it's got a complete monopoly on the market. When the restrictions really hit the news cycle back in April, it was within about a week and a half that the U.S. government had said they're willing to negotiate with China. And already when, the U.S. hasn't seen the pace of licenses being issued, there has been a vocal frustration. So China has a leverage here, and they're very strategically not getting rid of their export licensing framework, which gives them the ability at any time to decide what companies and which countries actually can access these permits. So there is no doubt that they are retaining their leverage very strategically. Countries like Australia, Saudi Arabia, and the U.S. are building their capabilities in parallel. But like I always say, mining is a very, very long-term industry. It can take decades to bring a mine online, and it takes still a number of years to build a processing facility too.
So Graceland, we're just about a month away, a little over a month away from the end of that 90-day tariff pause. In your view, what is this going to look like? What is the kind of net result going to be of these trade talks between the U.S. and China with regard to rare earths?
China has made it very clear they're not interested in the tariffs, and they need a slightly more permanent solution. So the extent to which the U.S. is willing to put a longer term guarantee, I don't think working in 90-day increments is going to work for the Chinese. And if it doesn't work for the Chinese, we're still going to see our rare earth and potentially other minerals with time be restricted. So this is certainly going to be a very, very powerful driver given the leverage they carry as China pushes for a more long-term solution with as close to zero tariffs as possible.
Graceland, really appreciate you joining us. Thank you so much for your insights this morning. We're going to have all your markets action ahead here on Yahoo Finance, so stick around. You're watching Catalysts. Cracker Barrel reporting slightly higher sales in its fiscal third quarter and boosting its full-year adjusted EBITDA forecast. But the restaurant chain expecting a $5 million hit due to tariffs in the fourth quarter. Shares are up over 3% at the moment. Joining us now, Julie Fels-Massino, Cracker Barrel Old Country Store President and CEO. Also Yahoo Finance's Brooke DePalma, who brought us the conversation. Julie, I want to start with you, of course. Thank you for joining us. Give us some insight into the impact of tariffs on the business. You obviously cited that $5 million hit. Just walk me through how you're thinking about the impact of tariffs as the policy continues to change.
Sure. Thanks for having us here. Look, I'm really proud of the way the teams have been dealing with the tariff situation. It's not new. It's been a topic since the campaign trail. So we've been working on this, thinking about our sourcing strategy, our SKU strategy, even the flow of goods. So the teams have done a great job on that. And we were really pleased that the impact to this year, we've been able to mitigate that down to $5 million and absorb that into our guidance and still be able to raise our guidance on the year.
Julie, I want to talk about vice versa, the impact that it's having on consumer demand. Your business is 80% food, 20% retail. Many people probably don't even know that. You did see a slight decline in same-store sales growth when it comes to retail. Are consumers just grabbing less out the door because of this uncertainty?
Look, the macros are really interesting right now. They're a little volatile. There's some good news, but a lot of the fundamentals of the economy are actually quite stable. We're seeing food away from home be consistent. It's a consistent measure over the last, probably 40 years that it's about 5%. Our job is to really make sure that people choose us when they're out. Everything that we have in that retail store is discretionary. It's wonderful. It's joyous. It's a treasure hunt. We're seeing people still choose us and shop with us, and we're making sure that we're delivering that great country hospitality and value every day for them on these items.
But maybe are they just grabbing less? Are they worried about their budgets right now and perhaps opting for the food, that essential, maybe not the discretionary?
We're seeing traffic up for us the last couple of months, and the choices that they're making are not suggesting that they're managing their mix. We reported again a very strong mix component on the restaurant side, and given everything that's going on, we're really happy with where the retail business is performing. So we're not seeing people really manage check at Cracker Barrel, but maybe that's because we are such a great value. We offer abundant portions of our delicious scratch-made food every single day at a great value. And don't forget, we have a loyalty program where guests can earn and redeem on both sides of the business. So we think that they find tremendous value in that. So we're pleased with how we're showing up. We think we're well positioned given the macros.
Can you talk about what you're seeing in terms of a little bit more specifics on consumer behavior? Have you seen them switching menu items? Have you seen any change in what they're buying in that storefront as well? Just talk to me a little bit more about whether you're seeing any signs of a change in that consumer purchasing power.
Really, we aren't. As we discussed yesterday on the call, our guests are pretty consistent across age and demographic barriers and kind of sizing this past quarter. So we haven't seen any shifts between over and under income levels or even age groups. What we are seeing is continued mixed growth, actually. So people are choosing items like our new campfire meals. They're choosing items like our hash brown casserole shepherd's pie. So we're actually getting a little bit of benefit from check. Which is interesting, and a lot of times you worry in situations like this that people might manage check or, to your point, choose less often to go out or to shop, but we're actually really not seeing that. Again, we think it's because we offer such abundant value at Cracker Barrel. Our price points are quite sharp too, Brooke. I don't know if you're aware, our average check is like $15, while the casual dining industry is $27. So we're very affordable for the abundance of the quality food that you get.
I do want to point out, Deloitte actually put out this new report in late May that says that more travelers are expected to take road trips this summer. You guys are a roadside chain. How does that bode for the business?
Yeah, we are optimistic about our summer. It's off to a great start. As we shared yesterday on our Q3 call, Q4 is off to an awesome start. We literally brought back a fan favorite, the campfire meals that guests and employees have been asking us to bring back for several years. We updated the flavor profiles, made them a little bit more flavorful, a little bit more helpful. They're incredibly abundant, and we added a value price point in the innovation of those meals. So there's now a shrimp and andouille sausage skillet that starts at $10.99. So we're here to welcome all guests this summer, whether they're up and down the highways or however they're coming in to see us. We're here to serve them and take care of them with our great food and country hospitality.
Julie, in a note from John Tower, he said that traffic growth was one of the concerns among Wall Street there. Is value and an increase in road car travel, will that bring in more traffic? Will that address this key concern among the street right now?
Yeah, look, I think that really stems from our Q3. Q3 was rocky. We're in the middle of a 3-year transformation, and as we've shared with the street and all of our investors, it's not going to be a straight line. We've got a lot of things that we're working on. I'm really proud of how the team's executing every day to both deliver the business today while we transform for the future. Q3, many people have already forgotten, but February, the weather was really bad and the macros were not great. So while February really was not strong for us, March, April, and May have seen sequential traffic improvements. We shared that on the call. So we believe the underlying health is going in the right direction for the business. Really, February kind of caught us there a little bit, but I'm really proud of how we actually strapped down and actually delivered the quarter, and we're able to actually keep EBITDA up and raise our guidance on the full fiscal year while protecting Q4. Because to your point, Brooke, we're ready for the travelers. We're ready to welcome everybody in. We started that, kind of this past weekend with the Cracker Barrel 400 as a great kickoff with our campfire meals to the summer, really welcoming people in. So we're ready for everybody.
Julie, we continue to hear from our sources across Wall Street concerns about any potential headwinds from the economy turning into a potential recession in the second half of this year. How are you positioned to withstand a recession, and what might that look like for your business?
Yeah, we think we're very well positioned. In times of recession, value-oriented businesses tend to do quite well. As I mentioned before, our average check is $15. So you get an abundant, really delicious home cooked meal for $15, which our competitors are way up at 27. So we think we are very well positioned. And remember, we also have loyalty. We have a $7.99 pancake special that's available all day, every day. We have early dinner dine that starts at $8.99.
Right.
We're not seeing a pullback in those spaces.
Yeah, and I do just want to point out something else that came up on the earnings call here, a question about any optimization on the labor side of things, potentially cutting back on costs by optimizing back of house. How do you see labor evolving going forward? Do you plan on cutting back on any jobs?
Quite the opposite. I would say we're always hiring at Cracker Barrel. If you've got a smile and you want to deliver some great country hospitality, we're here. We're ready to invest in you. And I think that's evidenced by the fact that our turnover number was actually up 14 percentage points Q3 year over year. So we are optimizing how we use labor. And I talked a lot on the call about the back of house optimization. A lot of the jobs at Cracker Barrel haven't evolved over the decades. And this project is really about improving the quality of food while making those back of house jobs easier to do and cooking more in real time to when the guest is in the restaurant. So that's what that phase is about. And there is cost savings associated with that, which we're seeing flow through the P&L.
All right, Julie, thank you so much for joining us. And thank you to our very own Brooke De Palma for bringing us the conversation. Appreciate you both.
Thanks, ladies.
Coming up, how investors are positioning and what our next guest calls a market purgatory. We'll get you that information next. Taking a look at markets continuing their gains after the May jobs report came in stronger than expected. With investors not expecting the Fed to cut rates until September, is this a good time for the risk on trade, or should investors be cautious due to the Fed holding a little bit longer? Our next guest says there's a case for both. I want to bring in Tracy Burns, Leventhal Global Advisors VP of Women in Investing, for today's FA Corner, brought to you by Capital Group. Tracy, great to speak with you. I know that you say that there's a bull and bear case for the current market, given the jobs data that we got this morning and the potential for the Fed to hold on for a little while longer. How does that impact where you're seeing the market heading? Oh, Tracy, I think we're having a little bit of trouble hearing you. We might have to come back to you in a second. Do we have you now?
I got you.
Perfect.
I'm very
Go
sorry
ahead.
about that.
No worries at all.
Okay, so we're in this, I'm even in this purgatory apparently. So we're in this weird spot where you can make a case for a bull market, you can make a case for a bear market. So what does that do? That lack of clarity sort of creates a little inertia on some level, right? But surprisingly, we have a consumer that's holding on. I mean, with all this tariff talk, I don't want to say we're numb to it, but we're managing it. And we're starting to hear that, you know what, maybe companies will absorb a little bit here and there. Maybe at the end of the day, it's not going to be so bad. Well, we're not going to get an interest rate cut anytime soon. Now we're looking at the fall. I think it's better than it was in January for sure, but it's certainly not sunshine and rainbows.
So Tracy, how do you invest without having conviction for either the bear or bull case?
Right. So I think you go back to the old school. Let's make sure we are well-diversified portfolio. Take the opportunity now. We're going to have more volatility before the end of the year. So make sure you're speaking to your advisor and saying, hey, if we need to rebalance, let's take advantage of this. Let's wait. Let's be smart. Let's put some cash on the sidelines if you have that ability to do so. A lot of people are looking at 2026 as the year that we're all done with this. So maybe you want to start chipping away at your shopping list. That way you are ready to rock and roll 2026 comes along. You and I both know anything can happen between now and 2026, though. So I think cautious investing, cautious decision making is utmost importance right now.
Yeah, and I want to bring in my contributor for the hour, James, on this, because I wonder how you're thinking about the definition of diversification in this environment and whether or not that has changed at all given the policy uncertainty.
Yeah, I think it has changed. I think Tracy has some good points. I mean, in some cases it's still a bull market. In some cases it's actually a bear market. And a lot of that comes down to policy and all economics. You know, in the U.S., as we talked about earlier, you've got tight money, you've got fiscal restraint. and tariffs, and so you get slower growth. So investors really, if the bull market in the U.S. is in the AI trade, which sort of is immune to a lot of that, and then sort of those consumer defensive type of companies like a Costco, and I think that where the real bull market is outside the U.S., where you have really good fiscal policy and you have very easy money, and where you're seeing earnings growth really do well. So I think investors want to be diversified. Be really selective, though, about the sectors in the U.S., and also don't be afraid to go outside the U.S.
Yeah, Tracy, I want to give you the last word on that. We got about a minute left here. What are you telling clients about investing internationally?
Yeah, look, like anything else, it's run up, right? So you don't want to buy high and sell low. So let's give it a minute again. Again, this comes down to cautious, well thought out choices. Sure, you should have a little in your portfolio, maybe 2.5% to 5% at best. But you don't go in guns blazing right now because it has been on fire, to your guest's point. So take your time, diversify again, add a little when you can. Wait till there's a pullback, though. Let's again be smart with our money you worked very hard for.
Tracy, great overview. Thank you so much for joining us. That was this week's FA Corner, brought to you by Capital Group. I want to give a big thanks to my contributor for the hour, James Demmert, Main Street Research's Chief Investment Officer. James, thanks so much for being here.
Been a pleasure.
Yeah, I want to take a look, too, at the major averages as we head to break. You're still looking at green across your screen off the back of that. Better than expected jobs number this morning, though the revisions, not so great, but we still have markets focusing on the positive. Your S&P up over 1%, your tech-heavy NASDAQ up 1.3%. Coming up, we've got wealth that's dedicated to all of your personal finance needs. Brad Smith is going to have you for the next hour, so stay tuned for more.